Welcome to Colliers Talks, a podcast series featuring the latest trends, insights, research, and developments in commercial real estate in Canada and beyond.
Gentlemen, welcome to Wine and Warehouses. This is Colliers' podcast about fine wines and industrial real estate. Here with my partner, Arnold Fox.
Hello.
Myself, Jean-Marc Dubé. We're both from the Montreal office for Colliers, and we have two esteemed gentlemen with us today, Mr. David Owen, who is the President and Chief Operating Officer for Pure Industrial, and we also have Jonathan Rovira, who's the Senior Vice President handling all of leasing across the country. Gentlemen, welcome.
Welcome, guys.
Thank you for having us.
So this has been a very popular podcast for Colliers and for listeners because we try and make it a little bit more fun. We talk about some great wines and we talk about a lot of fun things in the industrial real estate world. So today, what I thought we would do is get into some very interesting Italian wines. David, I know you like Italian wines. I know you like single varietal. I understand.
That is correct. That is correct.
So what we're going to be trying today is a Casanova di Neri Tenuta Nuova Brunello di Montalcino, okay, which is from the Tuscan region of Italy. This is a 2013, so it's got a little bit of age on it. What I thought we would do is, I always like bringing a little bit of my fun tools when we do these podcasts. I had a cool wine opener that I brought one time. The last time, brought my favorite Zalto glasses, and today we're going to talk about drinking responsibly. So I brought what we call the Coravin, which was an invention by an MIT professor who liked to have great wines, but couldn't bring himself to finish an entire bottle. Go figure. So what this does is it's got argon gas in it, and you literally do a little push like this, and then the wine pours into the glass, and it puts an inert gas in so that once you've poured your glass, you can actually save it in there for about a year.
Wow.
Oh, wow.
Yeah, it's very,
amazing.
very cool. So I'm going to pass
Which
these
never
on,
happens with us.
Yeah, it's not very often I pull it out, but it is, for a daytime podcast, it's a great, great tool. So, gentlemen, cheers. Welcome to
Cheers, everybody.
Cheers.
our podcast.
Welcome,
Thanks again
guys.
for having us.
Cheers.
So this is actually a really cool vineyard. Over the years, I've become friends with the winemaker here, Giacomo Neri, and I had this. I think it was in July this year. I brought my dad for the first time to Europe, and we went to see him at the vineyard, and he treated my dad like royalty. It was an absolutely fantastic trip. So I figured it was a good point to show this. So you guys tasted it. Any thoughts?
Delicious.
Yeah,
Amazing.
Those
Good.
are my thoughts.
yeah, amazing.
Pairs with pickled tongue.
Oh, yeah. So, guys, why don't we talk a little bit about Pure Industrial and your roles in Pure? It's evolved quite a bit over some time. So maybe you can give us, a bit of history of Pure Industrial, give us a bit of some of the basic activities, asset classes, and maybe some of the markets you invest in.
Maybe I'll start. I've been up here for 9 years. When we were a publicly traded REIT prior to Blackstone taking us over in 2018, we had a kind of a wide span of various geographies that we invested in, being Alberta, Ontario, a little bit in Quebec, BC, and then the United States. When we got acquired in 2018, we were really honed in on specific sub-markets within, I would say the densest locations within Canada. So that became a focus of Montreal, Toronto, and Vancouver. It's kind of how our strategy has dwarfed over time. We sold out of Alberta and we sold our U.S. portfolio. So a lot of growth has actually also occurred in Montreal and Quebec, more particularly from that 2018 go private. And then just generally in Toronto, we've continued to grow there. We also owned a portfolio in the prairies that we've sold out of as well. I wouldn't say that we're completely out of those markets, but generally our focus has been really to scale in these specific dense nodes and focus our time on not only building up the platform, but also the people that go with it.
So talk to me about your team a little bit.
Sure. So we have a primary leasing team is located in our Toronto offices and our Montreal offices, where about now we're sitting around 25 people strong. When I joined Pure Industrial over 10 years ago, there were about 5 of us. So it's definitely grown significantly, especially after the Cominar acquisition. Having said that, we have offices, of course, in Vancouver, 3 offices in the Greater Toronto area, and an office in Montreal and 1 in Quebec City. So over that time span, again, I joined in Pure Industrial over 10 years ago. There were maybe 20 staff. Today, I think we're well into the 200s.
Oh, you're kidding me. I didn't know that.
Yeah, when we got
That's
taken
great.
private, I think we had 38 people. Now we're at about 270. The majority of that growth, as John alluded to, was probably in Quebec, but also in Toronto. And we continue to add bodies where we see fit. I would also say that that's aligned to various additions to business segments. So we've added multiple business lines, customer solutions, customer experience. We've broadened out our building operations and facilities management teams across the platform, and also added, as with more GLA, you need to add more leasing bodies to the mix and asset management teams. So yeah, we've grown quite a bit. Our square footage has gone from around 26 million square feet. We're about 43 million square feet today. If you include our development pipeline, that's about 48 million square feet across those 3 major markets.
That's fantastic. And in a fairly short period of time.
Yeah. We tend to acquire in larger scale portfolios and be more competitive as a result of the platform that we have. So we've bought a bunch of large scale portfolios, Cominar being one of them. We also bought Artis's GTA industrial portfolio and a few other portfolios that have been, I would say, on the larger side of things. So scaling has been important to us, and that's where we see the most benefit. So we're not probably as active on smaller transactions, although we'll look at pretty much anything, but we've been pretty active on the large size stuff.
Well, I know because I remember when you somewhat entered the Quebec market, and it wasn't, you'd go to Toronto, you'd try to get people to be interested in Montreal, and they weren't. It was just a difficult market to deal with. But I would say that there was always a bit of interest from you guys, and Pure was definitely one of the early adopters of our market. And I guess that's probably, I've been working with Pure for many, many years. I think we were talking about it before, where we bumped into each other in New York City, and you were the guy from Toronto, and we were there talking to guys in New York. So it's really like, it's been a while. But you've always had a very entrepreneurial spirit, I think, with Pure and how you approach the market. So what do you guys think about that in your view of the Montreal market and other markets that you're invested in?
Yeah, I mean, so maybe taking a step back, we were about 1 million feet when we got acquired by Blackstone. We grew that up to 8 million square feet on kind of standalone acquisitions, and then we obviously acquired the Cominar industrial portfolio, which took us to a size and scale of internalizing operations. So we previously had that outsourced. We always want to manage our own properties to our own customers because we're extremely customer focused. I'd say the majority of what we focus on is meeting customer demands and needs, and that really helps drive not only performance but also just customer satisfaction, retention, et cetera. So a lot of where we've focused our time on the entrepreneur side is really because our businesses that we lease to are entrepreneurial themselves. So, and that's continuously evolving, as you guys know, on the tenor upside. They're always looking for new space requirements, whether it's smaller, bigger, different locations. We want to meet that demand. We want to do it in scale. So that's really where we focused our time.
Yeah, it's important to realize, for those who aren't familiar with Pure Industrial, that we own lots of buildings and different types of spaces, anything from 5,000 square foot, I would say manufacturers, millwood workers, customized kitchen countertop type of vendors, all the way up to 1 million square foot e-commerce, distribution, food, warehousing, etc. So within all those different segments, we have a lot of, I would say, customization for our customers. We have to be very good listeners and assist them with that entrepreneurial spirit. Despite our size and both our organization and the amount of staff we have, it always comes back down to those individual conversations that you have with your tenants, customers, that is, to ensure that we're giving them, enhancing their customer experience with us.
And Just to clarify for the audience, 100% industrial.
Pure industrial.
Pure industrial. Pure industrial.
It's funny. We were founded by two entrepreneurs, one who's passed away, and they started Pure Industrial and Pure Multifamily. So this is 2007. So you can think about the vision that they had for the two asset classes back then, and they had long-term conviction, which has been taken over by a multitude of parties since then. But so the entrepreneurial spirit is really within our roots, I would say, and it continues to be a focal point of our competitive advantage today.
So being on the industrial side, I've seen you be very active, not only in our market here, but across the country. And I'd almost say that you were able to see trends beforehand. What drives that understanding of the trends in the market?
I think it takes kind of two-pronged approaches. One is, we're part of the Blackstone ecosystem, which is a global I would say a massive global presence of not only portfolio companies and logistics businesses in multiple parts of the globe, but also of data and aggregation of data. And that's really part of the reason why we were acquired originally by Blackstone, is they had a fundamental long-term thesis in e-commerce and the trends that they were seeing in other parts of the globe that Canada really hadn't caught up to yet. And then that's kind of transitioned to Pure and the insights that we gather on a regular basis. Given our size and scale, we have internal information that leads us to trends, I think, a little bit faster than just relying on third-party market research, which is typically backwards looking. So a lot of what we do is focus on where's the demand coming from and why, and how can we help position our portfolio to meet that demand.
I think what's great is with our geographic spread across Canada, we're able to share the experiences of the people on the ground, whether it be our operators, property managers, our leasing staff, and even the asset managers. Having these conversations, there tends to be sort of, I would say, lags or patterns that take place over time. And with that coverage and our scale, together with Blackstone's, I would say, ability to gather data, interpret it, and find those patterns moving forward has helped us tremendously, I would say, in the last few years, significantly.
I get to speak to, CEOs in the U.S. and Europe and Asia and Australia, and it's really a collective, effort to see where are we seeing trends happening real time with businesses and with the consumers. And obviously, every market is different, and they're going through different economic growth cycles, but generally, deriving that tailwind, if you will, with the consumer has been super important for us.
So it almost gives you a global experience and global view to bring to Canada.
Correct.
Right. Excellent. And speaking of globally, one of the things that we're hearing on everybody's wish list is a lot of ESG stuff that we're discussing in regards to environmental and how is Pure adapting to that in the Canadian market?
Yeah, so for us, everything we do is really focused on the customer. And right now, the biggest piece that we're seeing is there really is value to be provided to the customer by upgrading facilities to both be environmentally friendly and cost effective for customers. So that's where our focus resides on the sustainability side of things. With respect to the social and the governance side of things, we're, I would say, more than meeting the market, but from a quantifiable sustainability metric, our customers are our focus. On the S and the G, it's our employees, our stakeholders, who we deal with on a consistent basis, such as you guys and brokers, and then our investors from the governance side of things. So it's really about our stakeholders that we focus in on, and
On the ground, leasing every day, I think it's been great to, I would say, deepen our relationships with our customers, specifically with offering them, I would say, benefits of the scale that we have. So, for example, most recently, we've been offering them free energy audits to see if they would benefit from changing their lighting. Of course, that would lead to likely reduced utilities. And a lot of the times these clients are so busy with their business, they don't even have a chance to take a step back, breathe, and realize I could obtain savings within 6 to 9 months of just changing some light bulbs or some fixtures.
You're being proactive when you're going to be.
It's just giving them an option and having them be able to say, yes, I would like to find out if I will actually have savings down the road has just been a real benefit. And they do find it as more of a partnership garnering development, relationship with Pure. And so we're always trying to discover different ways that we can provide different levels of service that we just haven't really touched on before.
I would assume most are receptive.
Oh, I would say the vast majority of them are.
It costs nothing to them. So for us, it's let us do this and show you what can be done. And if it does help to provide that, then great. If it doesn't, then
That's great. Yeah.
And then from there, if there's probably bolt-ons to that we could accomplish in the future. I don't want to go the route of solar or anything like that, but even just electrifying your HVAC system, getting rid of natural gas, that's something that we're doing across the portfolio for the landlord managed HVAC that we have in any event. So, we're constantly trying to improve not only our carbon footprint, but our customers as well.
So that's a great segue, because when you mentioned before about the Communard portfolio, might have been one of the largest, if not the largest, industrial acquisition in the history of Quebec.
Might be Canada
Debatably.
even,
Right. Mm-hmm. You inherited a lot of older facilities, a lot of small bay stuff, a lot of low clear heights that needed love. So how are you managing that? I know firsthand from some of the work that we've done with you what you're capable of, but it's a difficult task, especially when you're talking about a portfolio of your size. So how are you dealing with that?
Yeah, so it's two ways. The first is really having the people and the skill sets required to address this type of an issue. So, we've added in significant amount of bodies that help not only understand the assets but also replace, repair, and extend the useful life. I think from our perspective, you're doing two things by accomplishing that, by spending on buildings. One, you're making it more appealing to do lease deals, but you're also improving older generational assets and extending their useful lives, which in the long run is much more sustainable than building new. So by prolonging, older buildings in our world, you're adding to the appeal of extending their their useful life for further usage in the future. And I think that's something that's really important to us. The product offering that we provide to our customers is, I wouldn't say it's completely streamlined, but we've tried our best to streamline it so that it's applicable to all types of shapes and sizes and uses. And that, I think, generally we've had positive feedback across the board in that respect. And we're trying to do a little bit more of that in-house to increase the speed with which we're able to execute on this type of work. And it could be white boxing warehouses, it could be replacing dock doors, it could be reducing the size of offices, making sure that the spaces are fire code compliant. That's a third party, but just little things like that, so that it's really easy for a customer to envision the space when they walk in, and then it's easy for them to execute on that vision. Sometimes when you're not code compliant or you haven't improved the space, it just delays for them to get in the space and then start operating their business. So we're really trying to reduce the downtime overall. And overall, it produces a better product for us in the long run, a more marketable product if we were ever to sell. And so that's really the important piece from our perspective.
What's great about working at Pure is that we actually have a truly collaborative, cohesive relationship between the different departments. So it isn't like we do the leasing and then you hand it off to the property management or operations group that will then, let's say, service the customer for the years thereafter. It's always an ongoing conversation. How is this customer doing? Is the space working for them? What did we not do right away? What can we do better to improve on that? And there's always these constant conversations together between all the different groups, including legal, including asset management, that keeps every asset almost like we do, not all also, but we focus on creating a very unique plan for each asset and each customer that makes it very, I would say, ties us back to the entrepreneurial roots, where the customer knows that they can ask us anything and everything, and we'll do our best to provide that service, regardless of how large we grow and what areas of the market that we start to grow into.
So it sounds like you've got a great handle on what's happening in the business today. As part of the leadership group, what's the vision for Pure short-term, long-term?
Our focus is kind of threefold with a 3A, if you will. One is just like continuously improving things for our customer and increasing customer service, not only from an offering perspective, but also just doing what we can to make sure that our spaces are attractive to customers for the long term. I think optimizing existing assets is a second one, and that could take a couple of fold. That could be for a customer, that could be for a sale, or that could just be for the environment and the community that we're in. And sometimes you see an asset that's dislocated. Making sure that you have a plan towards that asset is so important, not only for us, but the stakeholders around who live in the community or who commute there every day and work at that asset every day. And then the third is just continuously expanding in our key markets. We have a platform, we have scale, and for us, it's all about expanding our presence within the markets that we compete in. So those are kind of the three, I would say, short to medium and long term. And the 3A would be on the sustainability front and that frontier, and taking on more of that on in the future as we continue to try to get away from carbon uses within our buildings and reducing our carbon footprint.
And to complement all three of those, short, medium, long-term objectives, really the essence of that is really to focus on listening to our customers, to our tenants. We actually have a new department called our customer experience group. And that isn't merely just a hotline for customers to call in or to complain. We proactively go and seek feedback from our customers, whether they be tenants or brokers or vendors, and try to see what could we do better? What are things we do really well that we should expand on? And it's ensuring that we're always in this cycle of improvement and doing better for next time, and recognizing what we've done well so far that continues to allow us to just do better at everything. So it's always a place of growth and learning. So it's an exciting time for us all the time.
That's good. So it gives us a really good understanding of what's going on with Pure right now. Love to chat with you guys about the market, because there's a lot going on in the market right now that's worthy. But I think before we do that, we probably need to take another sip of our Brunello that's been sitting in our glass for probably around 15-20 minutes. I bet you it tastes different than it did 15-20 minutes ago. It's had some time to oxygenate. And just so that you guys know, we were talking about single varietal. This is Sangiovese, but this Casanova di Neri is actually also single vineyards. So Tenuta Nuova comes from 3 single parcels that are basically vinified by the Casanova di Neri family. So delicious. Yeah, it's good.
Don't you love drinking at this hour?
Where's the steak? Are we gonna get a steak?
This is not so bad. Arnold and I did a podcast at 9 a.m. one day, but for that we brought a Burgundy because it's a bit lighter. This is, as you guys know, it's a medium-bodied wine. So the steak would go very well with this. So if we start talking about the Canadian market, I think right now we're seeing a lot of ebbs and flows, right, in the market, specifically in the industrial market. How do you think, and sort of backtrack, but I think we're probably seeing a little rollback on interest rates that are come. It's going quicker than we had expected. I think next week we're talking about maybe another 0.5%. How do you think that interest rate environment has impacted the Canadian real estate market?
Maybe taking a step back, because I like to look back at what had happened to get us here. And, rates rose extremely quickly. That really, the group of individuals that hit the most was our customers. Consumer confidence dropped off a cliff, sales dropped, and then, business confidence followed. And then with business confidence falling off, investment within the supply chain fell off. So we've had a moderation of a moderating period of neutrality for, I would say, over 18 months now, and only within the last quarter have we really started to see that kind of, I would say not bottom, but we've started to see some light at the end of the tunnel from a consumer confidence perspective, and that should hopefully transcend into the business side of things. On the customer itself, we're looking at, okay, are their sales increasing, or at least are we seeing some positive momentum in that regard? How are their inventory levels relative to what they have been over the past couple of years? Are they committing to future business investment? And that could be anything from investing in a new facility, to expanding a facility, to investing within one that's maybe a little bit more investing in new machinery, et cetera. Because that's really a sign for us that demand is turning the corner. On the investor side, so taking a step back and looking at it from the capital market side of the world, you saw rates hike up in a very, very, very quick fashion. And I think cap rates didn't go in lockstep with it, but expectations of cap rates for sure were impacted. And as a result, you saw kind of muted investment activity over the past 18 months. That's just because the bid-ask spread between buyers and sellers are just too wide and has been too wide. We've slowly started to see that come in, especially with the rate drops that we have seen. But we're still not at a place yet. But we're starting to see light at the end of the tunnel that could be opening up as well.
Yeah, I think that the margins for a lot of our customers were impacted with volatility in interest rates. Now that we're seeing it come down a little bit more, they're feeling a little bit more comfortable about saying, I've lived with my same sized warehouse now for 5 years. I think now is the time where I can consider a relocation or a little bit of growth. We do see some green shoots starting to appear. And I think that most groups are more, again, cautiously optimistic to see what will lead into 2025 with regards to consumer demand. And I think we're pretty, I would say, optimistic as well towards the middle and the end of next year.
Yeah, I would agree. I think in our discussions, we're always pretty optimistic about the industrial market. It was a difficult first 6 months of the market because I believe that those interest rates had a lot of impact, as you were mentioning before, on inventories, especially because no one is buying inventory cash. They're doing it on financing. They're doing it through credit lines. After Labor Day, we started to see a pretty big peak in 3PL business. And what that typically tells us is that tenants or customers, as Pure refers them to, is they are starting to test the market again. They don't want to go and sign a 10-year lease themselves, but hey, why don't we test it with a 3PL? So we're seeing a little bit of that right now. Brings me back to a trip that we did in Chicago for the Colliers Industrial. It's the Americas, but the Canadians, so we always sneak our way down there. The sentiment was thrives. Originally, it was survive to 25. Then it was thrive in 25, and now at the Toronto Real Estate Forum, we saw fix in 26. What are your thoughts about where we're going with the market?
I always look back to simple macroeconomic. I mean, the consumer in Canada has been hurt pretty bad by interest rates. I mean, we have 5-year mortgages. In the U.S., they have sometimes 40-year mortgages. They're less. They're definitely more inelastic to interest rate hikes.
David, people don't realize when you talk about 5-year terms, but that means that every single year, 20% of our mortgages roll over.
Correct.
That's a huge amount of mortgage.
Yeah, and so as that consumer, and we're dealing with that in as well as some of the highest housing costs, within the G7, and wages that have been stagnant more or less for two to 3 years. So, you add those together, discretionary spending fell off a cliff. It has not fallen off as significantly in the U.S. Maybe over the last month or two they've seen kind of slowdowns, but not to the extent that we saw over the past 2 years. So I think they're just in a little bit of a different spot from that growth perspective. Consumption has continued to chug along. Their GDP, I think real GDP is like north of 3%. Ours has been below 1%, I think, for four or five straight quarters. And don't quote me on that, but something in that range. So I think it's just a little bit of a different market dynamic, and it's because we're much more susceptible to changes in interest rates. You pair that with general consensus. Their supply situation is also much different from our supply situation. We can talk a little bit more about that later, but there's 52 markets in the U.S. There's really 3 to 5 in Canada that are of scale. So it's a little bit different when you look at it from that perspective. It's just a much larger.
Well, I mean, they've had a much softer landing than we have, almost like a Goldilocks effect.
I don't know if they ever fell off.
Good point.
I don't know, like not that we have in any event. So they're starting to see it now, but it's not. I would say it's not to the extent that we've seen.
So, and I mean, we're speaking about the U.S., so it'd be really difficult to not talk about I guess, which will now become an infamous tweet last week, or it might have been the week before, in regards to tariffs. And we saw just from firsthand, I mentioned before about how we were seeing 3PL. 3PL work was really starting to ramp up, a lot more requests than what we had seen in the past. And then it was that tweet seemed to put a cold shower on everybody. And it wasn't, well, that's it, we're killing our projects, but it was definitely, well, it's December, it's already not that busy. So why don't we just put a hold on things and go into a wait and see mode? Are you seeing that?
So, I mean, I think it's really early days, and by no means know a whole lot about the U.S. business environment, but I know that it's early days, and what I would say is that Pure is well positioned to meet the demands of the Canadian supply chain. That's really our focus, and the majority of our customers are local and regional suppliers. We do have obviously some large national businesses, but generally we're focused on that Canadian consumer. You know, as we look at our book, I mean, there's really not a significant amount of exposure to U.S. Canada supply chain differences. I think the overlap of those businesses, you look at the battery trade as an example, you know, that we don't have any exposure to that except for, you know, one manufacturing facility in Ontario, but that's exporting to either the U.S. or elsewhere. So I think generally that's probably a positive story, not really a negative one. And
Interesting.
Yeah, I mean, generally, I think if we're producing, and this is a small manufacturer, by the way, this isn't, you know, the one, the Volkswagen plant in southwestern Ontario.
Right.
This is you know, roughly 100,000 square feet. But it's I think it's a positive story. By the way, we've had that leased for over eight years to the same business, so it's not like, you know, this hasn't been, you know, I think most of that is to the Canadian supply chain in general. So, you know, it's tough to say right now how things will be impacted, but I do think in general most of our focus has been on the Canadian supply chain.
It definitely has not slowed down our plans for next year. We've been ramping up with more bodies on the leasing side, on the marketing side, on our customer experience side. We're really putting ourselves in a position to be ready and not have to respond to when the market is, you know, taking off once again. So overall, within the four walls at Pure, we're pretty, again, we're going to be prepared and ready for when that upswing takes place.
So you do see an upswing coming? I do.
Personally, in my opinion, I do see one coming. It's just about the timing. You can't really put a pin on it, but it will come.
Well, I think when I look at the cost of debt, which has really affected the development market, and even in Montreal, I'll use that for ourselves because it's where we are. It's been a real showstopper for development, and there's very, very little new product coming to the market. I think right now we are approximately 1.4 million square feet, and if you look at that ratio as to inventory, we're the lowest in North America. So I don't see how we're not going to get back into a space crunch in Montreal. Is that the same across the country?
I think it's fairly accurate. I don't know the exact percentages, but probably in the same wheelhouse. In general, we've seen starts from the peak of Q4 of 2023 come down about 80%. So that kind of tells you where things are trending. And then as well, the land positions that are held, you know, in the GTA as an example, I'll just use it as are primarily institutionally owned, and those are long-term, you know, land positions that the institutions are not going to rush to put into production. And you got to remember, our development cycle is not, you know, 9 to 12 months like it is in some countries. It's 2 to 4 years.
Right.
So, you know, those decisions are not made overnight, and I think that generally has, you know, positive supply and demand impacts in the future for landlords. I would also caveat that and say it really depends on what size you're in. You know, I think on the large side of the world, that's where most of the new supply was delivered from 2022 onwards, and that's mostly because of the demand that was coming out of COVID. It was primarily large bay in nature. There's virtually been no small and mid bay product built, especially in Montreal, Toronto, and Vancouver. So
and the stuff that's being built, for what I've seen, is a strata. Basically, it's condo, right. and that's even a fraction of anything. We're getting zero in Quebec.
Well, it's very costly to build that type of product today, and to find the land as well.
Right.
Yeah, I think it'll be a long time before we see anybody building small bay for rentals, for purpose rentals. I mean, at one point, it didn't, we thought that a lot of these lower height buildings were going to get knocked down and then repurposed for much larger buildings. But those smaller bays are fetching similar rents to large bay, high ceiling. So what's the point of going through the development?
And there's still demand for them.
And there's tons of demand for it.
Right.
So speaking of demand, where do you see that going across the country right now?
Yeah, I think just anecdotally, in 2023, we saw the majority of new inquiries, RFPs, if you will, focused on consolidation plays, which tells me people are contracting and it's probably net neutral from an absorption perspective. In the last quarter alone, we've seen, our two highest volume months ever, October and November. And that's really been predicated primarily on the net new side on expansion, which is positive from our perspective. So, I mean, it's a very small sample size, but, post Labor Day, that's where we've seen the majority of the uptick in activity. And it's been on that expansion area. And we try to track that as best we can. And it is helpful to see finally return to expansionary times. And that's where we think, that's kind of where we alluded to earlier, where we think maybe business confidence is shifting a little bit.
On the ground with regards to recent leasing inquiries, there have been several requirements requiring additional power. And power has become quite an asset,
very
sought
point.
after. I think that's good news for us. Even I'm thinking about one of our buildings where an old crane user left and a new one now wants that space immediately. We had concerns that no one would want it for quite some time, and I think we're quite pleased to see that level of activity on spaces like that. So now these are on not the large bay size, but more the medium bay sizes, but it's still nice to see that folks are willing to invest in capital expenditure at that level now, where it was very quiet in the summertime.
And that's the manufacturing side of our economy, which is important.
Yep.
Yeah, exactly.
So I guess closing question now. What do you see the Canadian market, or where do you see the Canadian market on the industrial side going within short term, next 6 months, and maybe even a little bit longer term, 2 years down the road?
I mean, maybe just like looking at 2025, I think we'll probably see availability peak at some point in Q1 or Q2. And I think we'll probably start to see some positive absorption in the tail end of the year, which will be positive, meaningful absorption, ceteris paribus, without any external shocks, obviously.
Right.
But generally, that's kind of where we hope to see, things leaning. And that should cause, availability rates to come in a little bit by the end of the year and a return to more normal market times. I do think that it's probably the closest it's been to a equal market footing with tenants for since pre-COVID, and I think that's like a natural and normal friction to have within the marketplace. So I would say it's basically been a return to normalcy, and I expect that to continue, especially with new supply coming down as a percentage of total stock. But generally, it does bode well for businesses to make investments if rates are coming down, consumer expectations are going up. I think all of that kind of bodes well for the industrial market. We are at the heart of the Canadian economy, so when rates come down and there's better macroeconomic events occurring, I think you're going to start to see Canadian businesses start to spend again overall.
I think that there's going to be a lot more emphasis on same-day shipping, and that will expand throughout Canada. It, of course,
we're seeing that a lot.
It's already in Toronto and Montreal, but I think that it will start spreading out to more of the suburbs, and we're going to really observe how that impacts a lot of our leasability. A lot of our units, again, are almost basically irreplaceable, being smaller infill location, just something you can't replicate or duplicate with scale due to the cost and just location. So I think we're set up for success as that continues to grow. But again, it's all about the timing and being in a position when that inflection point takes place. Yeah.
And I think we're pretty bullish too.
Yeah, we are.
You know, we see, you know, we always look at it. You guys are lucky because you see it on a national basis. We see it as a bit of a microcosm in Montreal. But I think generally we follow other cities. And, you know, I think, David, I think you're right. I think we're going to be likely Q1, Q2 will be, I guess we would call the top of availability and vacancy. And then things are going to start to spur on. And that lack of development is really going to show itself in 2026. So, you know, we just keep chugging along. So,
Excellent.
Gentlemen, it's been a real pleasure. Thanks for joining us. Thank you for taking time out of your busy schedules. And I know you guys travel a lot as it is. So I guess we'll do a last cheers. And
Cheers. Our pleasure.
Cheers, guys.
Thank you so much.
Thank you for
good
the
to have
wine
you.
and warehouses.
Thanks for listening to Colliers Talks podcast. To learn more about Colliers Canada, our experts, and our solutions, visit collierscanada.com or find us on LinkedIn, Twitter, and Facebook.